Welcome to the Explainer. Today, we're going to crack the code on reclassifying financial assets. And look, this isn't just about passing your next quiz. This is about building a mental framework that's going to stick with you all the way to your board exams and, yeah, even into your career. So, let's be real. You just aced that quiz, which is awesome. But how do you make sure this information doesn't just, vanish from your brain in a week? How do you lock it in for the long haul, like 3 years from now when you're staring down the LECPA? The key isn't just cramming. It's about building a system that just clicks. So for a minute, let's just forget the textbook rules and build a mental map your brain will actually remember. Okay, here's the trick. To make these rules stick, I want you to stop thinking in abstract terms like amortized cost or FVOCI. Seriously, erase them for a second. Instead, picture 3 very specific, very physical warehouses where your company stores its assets. This simple analogy, it's going to be our guide for everything. So each warehouse has a totally different business model, which is the key to all of this. First up, you've got the vault. Think of it like a bank vault. It's safe, secure, and you're just holding stuff long-term to collect payments. Super simple. Then you have the showroom. This is your hybrid model. You're collecting payments, sure, but you're also showcasing the assets, ready to sell if a great offer comes along. And finally, the trading floor. This is pure action, fast-paced, high-frequency buying and selling. Once you get the purpose of each warehouse, everything else starts to fall into place. All right, so you've got your assets all neatly sorted into these 3 warehouses based on your strategy. Now, for the million-dollar question, when are you actually allowed to move an asset from one warehouse to another? The answer is super simple, but the rule itself is incredibly strict. This is it. This is the one and only trigger. It's not about waking up one day and changing your mind. It's not about reacting to a crazy market. It has to be a deep, fundamental, strategic shift in how you manage an entire category of assets.
And what this fancy language is really telling you is that this is a huge deal. It's rare. We're not talking about a manager's decision. We're talking about a decision made at the very top, by senior management, by the board of directors, that changes how the company operates. And you better believe you have to be able to prove it to your auditors.
Now pay attention, because this slide is critical for avoiding the most common exam traps. Let's say the market crashes and you suddenly get nervous and want to sell a bond you had locked away in the vault. Does that count? Nope, not a chance. The entire strategy for that type of asset has to change across the whole company. It's about the model, not your mood.
And what in the world does prospectively mean? It just means you don't go back in time. There's no DeLorean here. You can't rewrite your old financial statements. The change takes effect on the very first day of the next reporting period. It's a clean break, and everything moves forward from there. Okay, now for the how. Let's map out every possible move you can make between our 3 warehouses. But I need you to pay really close attention here. We're going to focus on debt securities first. Why? Because equities, well, they play by a completely different and much simpler rule. And boom, here it is. This is a massive dividing line in the rules. For debt securities, if that big business model change happens, you have to reclassify. It's required. But for equities, it's a one-and-done deal. The choice you make on day 1 to put it in FVPL or FVOCI is permanent. It is locked in. Forever, no takebacks. Okay, I know this table looks like a lot, but don't try to memorize it line by line. Let's just look for the patterns. See how any move that ends up in the trading floor hits your profit or loss? That's a pattern. And check out the move from the showroom to the vault. That one's pretty unique. You take those quiet gains or losses that were sitting in OCI, and you actually use them to adjust the asset's new cost. We're going to simplify this even more in a second.
All right, that table is great if you need the details, but for your board exams, you need rules you can pull up in like 5 seconds flat. So let's distill all that complexity into a few super simple, super powerful brain hacks. Here's your first hack. The trading floor is loud, it's public. So when you move an asset there from the quiet vault or the stylish showroom, all of its past history, all those unrealized gains and losses suddenly get announced to the world right there on your main income statement. Everything that was in OCI gets recycled. And now for the opposite move. When an asset leaves that crazy high-stakes trading floor for the calmer vault or showroom, you get a completely fresh start. Its fair value on the day you move it becomes its new cost. Poof! Its wild trading history is gone, wiped clean. So what about moves between the vault and the showroom? Well, think of them as close cousins. Any move between these two is handled quietly, kind of backstage, in other comprehensive income.
It doesn't immediately show up and create drama on your main income statement, which keeps your reported profits way more stable. This is it. This is the ultimate brain hack, because it's the easiest rule to remember, and I promise you, it's the most common exam trap out there. If you see a question asking you to reclassify an equity investment, the answer is always, you can't. It is not allowed. The initial choice is permanent. Lock that in. And here is your final cheat sheet. Right before an exam, this is what you review. The trigger, rare and high level. The timing, always forward-looking. The rule for debt, follow the paths. The rule for equity, don't you dare. And the big P&L impact, moving to FVPL, means everything hits your income. If you know these 5 points, you've got this. So I'll leave you with this question to chew on. Thinking about this moves you from just memorizing the rules to actually understanding their impact in the real world. And that right there is the kind of thinking that's going to make you an amazing CPA. Thanks for tuning in.